Buying shares in a company means purchasing ownership in that company. Each share represents a small portion of the company's ownership, and as a shareholder, you benefit when the company performs well. Shares are traded on stock exchanges like the New York Stock Exchange, NYSE, or NASDAQ, making them accessible to individuals and institutional investors alike. When you buy shares, you become a part owner of the company, with rights that may include voting on important decisions at shareholder meetings and receiving dividends if the company distributes profits. For example, if a company earns significant profits and declares a dividend of $2 per share, owning 100 shares would earn you $200 in dividends. Investors buy shares for two main reasons: capital appreciation and dividends. Capital appreciation occurs when the price of the shares increases over time. For instance, if you buy a stock at $50 per share and it rises to $70, you gain $20 per share if you sell. Dividends, on the other hand, provide a steady income, making shares appealing for both growth and income-oriented investors. Shares are categorized into two types: common shares and preferred shares. Common shares are the most widely traded and give shareholders voting rights, but their dividends are not guaranteed. Preferred shares typically don't offer voting rights but pay fixed dividends, making them less risky and more stable for income-focused investors. The process of buying shares is straightforward. First, you need to open a brokerage account with a platform like Fidelity, Robinhood, or Charles Schwab. Once your account is funded, you can search for the company's stock ticker symbol and place an order to buy shares. You can choose between a market order, which buys the shares at the current price, or a limit order, where you specify the maximum price you're willing to pay. Investing in shares carries risks and rewards. Shares have the potential for high returns as companies grow and expand. For example, early investors in companies like Apple or Amazon saw massive gains as these companies became market leaders. However, the stock market can be volatile, and share prices can fluctuate based on factors like earnings reports, economic conditions, and industry trends. This means it's possible to lose money, especially in the short term. To manage risk, investors often diversify by purchasing shares in multiple companies across different industries. For instance, instead of buying shares only in tech companies, you could include healthcare, energy, or consumer goods stocks to spread risk. Many investors also use index funds or exchange-traded funds, ETFs, to gain exposure to a broad range of shares without having to pick individual stocks.